So, what if the very rules that were designed to protect our financial system were, well, actually making it riskier? Today, we're going to dive into a pretty major proposal from the Federal Reserve that's trying to fix exactly that. And believe me, this isn't just about big banks, this is about the stability of the whole economy. It really all boils down to this one critical question. Are the biggest banks out there gaming the system? It's the kind of thing that probably keeps regulators up at night. The big fear is that these financial giants have found little loopholes to make themselves look safer than they really are, and now the Fed is stepping in to try and close them. Okay, so to really get why these new rules are such a big deal, we need to talk about how we police these giant banks right now. It all comes down to something called the GSIB surcharge. And first things first, let's get our terms straight. We are talking about GSIBs. That stands for Global Systemically Important Banks. Just think of them as the heart of the entire financial system. If one of them fails, it could send these massive shockwaves through the global economy, kind of like how a heart attack can affect the whole body. So how do we keep that heart healthy? Well, regulators make GSIBs hold on to extra cash, or capital, just as a safety buffer. And to figure out how much, they use two totally different scoring methods. It's kind of like you're judging a baking competition, right? Method 1 is like judging a cake based on how it stacks up against all the other cakes in the competition. Method 2, on the other hand, is like judging it against a very specific fixed recipe. The bank's extra capital requirement? It's based on whichever of these two scores ends up being higher. And for a while, this two-method system seemed to work just fine. But lately, the framework itself is starting to show some pretty serious cracks. These two methods, they're just not in sync anymore, and that's a big problem. And here is where things get a little concerning. For years, these two scores basically moved together, in lockstep. But since 2019, they've completely gone their separate ways, and that's creating a pretty dangerous gap in how we're actually perceiving risk. And this chart just illustrates the split perfectly. The dotted line, that's method 1. It stayed pretty flat. But just look at that solid line. That's method 2. It has absolutely skyrocketed. So what does this mean? It means our two main tools for measuring risk are giving us completely different answers. It's like having two compasses pointing in totally opposite directions. You just don't know which one to trust. So what caused this massive split? Well, in short, the economy just went into overdrive. You had government stimulus, a post-pandemic spending spree. It all flooded the system with cash, and that caused bank assets to just balloon to historic levels. And you can see that growth right here. GSIB assets just took off after 2019, blowing way past the historical trend. And because Method 2 uses that fixed recipe from way back in 2015, it sees all this new growth and automatically flags it as higher risk, even if a bank is just keeping pace with the larger economy. But the problems don't stop there. There's another, more hidden flaw in the system, a loophole that lets banks play this clever little game with their numbers. You see, the rules are based on a single snapshot in time, December 31st. It's a practice called window dressing. It's kind of like a student who only cleans their room on the one day they know their parents are coming to visit. The room looks perfect for that one moment, but it's not at all an accurate picture of the other 364 days of the year. For banks, this means their official risk score might be artificially low. Okay, so to fix this pretty outdated system and close that window dressing loophole, the Federal Reserve is proposing a major overhaul. Let's take a look at how they're planning to build a stronger and, frankly, more honest framework. So the fix really comes in three parts. First, they're updating that fixed formula to account for all the economic growth that's happened since 2015. Second, and this is huge, they're ditching that December 31st snapshot for a year-round average. And third, they're refining how they measure a bank's reliance on short-term wholesale funding. You can think of that as those risky overnight loans between financial institutions, to get a much more accurate picture of its stability. This slide really just perfectly illustrates the shift, from a snapshot to a movie. Instead of one single picture taken on December 31st, the Fed would get a continuous film of the bank's activities using daily and monthly averages. This simple change completely gets rid of the incentive for window dressing. Okay, so we've got a more accurate formula. We've got a year-round view of risk. What does all this actually mean? For the banks, for the financial system, and for the broader economy? Now, you might think all these new rules would mean banks have to hold more capital. But, and this is surprising, the net effect is actually a modest reduction. See, this isn't about just piling on new burdens. It's about making the existing rules smarter. And this is really the crucial balancing act. On one hand, by right-sizing capital requirements, the Fed could actually free up banks to lend more, which of course helps fuel economic growth. But on the other hand, the goal is to make the system even more resilient by making sure the capital a bank holds is perfectly aligned with the actual risk it poses all year round. So when you boil it all down, these proposed changes are really about one thing: getting a more accurate, more dynamic, and more honest picture of systemic risk. It's about making sure the rules actually keep up with the reality of our modern economy. And hey, don't just take my word for it. The Federal Reserve itself says its goal is to better align surcharges with GSIBs' systemic risk profiles. In other words, this whole thing is all about precision and accuracy. Which leaves us with one final and pretty essential question. These are smart, targeted changes designed to make our financial system more robust. But in a world of ever-evolving complexity, is this kind of fine-tuning really enough to prevent the next big crisis? Well, that's the question that regulators, and frankly all of us, will be asking.